Hi, I'm Anthony, an asset protection and tax attorney,
And I'm Zachary Esch, a CPA.
and you're listening to the Wealth Planning Podcast with Brister Law.
All right, guys, so today we're here to talk about the 8 things business owners should do before year end. Anthony, do you want to kick us off?
Yes, we put together these 8 things to help you guys, and really every single business owner should be doing this, speaking to their advisors about it. The first thing that I have for you guys is to have a tax planning meeting with your advisors, not just your CPA, but your financial advisor. If you have a tax attorney, get them all in a room together, review your financials, and make sure that they're all working towards that same goal.
Yeah, Anthony, I agree. I mean, everyone really at least once a year should be meeting with their tax advisor just to get on the same page with everything. And if you've never met with the tax advisor, now's an amazing time to do it. I have a ton of friends that come to me all the time asking for tax advice, and the biggest thing I tell them is just meet with someone because they haven't done that yet.
Yeah, certainly, Zach. And most of you business owners, you're good at what you do, and you should be meeting with a tax professional who's good at what they do, so they can maximize your tax returns and minimize your tax liability.
Oh, I 100% agree. I have a ton of friends that are business owners, like you're talking about, and they are great at what they do. And some of them do try to handle taxes on their own, but they're easily overwhelmed and it's easy to miss stuff because how do you focus on both things? A business takes your full time.
Yep, and you can't be a master of all trades. So
Uh,
the next,
Unless, unless you're a tax lawyer, then you got to run a business and your own taxes.
yeah, you're right on that. So the next thing that I have, it's a very simple one. And it really doesn't have to do with taxes, but it's review your succession plan, or if you don't have one, create one, and not just for your business, but also for your personal life.
Anthony, I guess let's go into why would you want a succession plan? This is a little outside my knowledge.
Yeah, so you want to have a succession plan to ensure that your family's taken care of if something happens to you, not only if you die, but let's say you get in a car wreck and you get in a coma, who's going to be able to help your business and transition it while your family's grieving or trying to handle your affairs. So it's good to have something in place, some kind of instructions, so that your family knows what to do and your business can transition as smoothly as possible while you're absent or not there anymore.
Oh, that's a great point, Anthony. That takes us back to the old In-N-Out Burger conundrum where they were going to quickly be one of the biggest expanding restaurants in the world. And due to an unfortunate accident, they got set back basically 20 plus years over not having a succession plan.
Wow, I didn't know that. And just like for your business, having a succession plan is important for your personal life too. One, not only to make sure that your assets are efficiently transferred to your heirs, but also, if you have a family with young kids, one really important thing that's really important to me is you need to name a guardian for your kids. I have a personal story that, my mother passed away when I was younger. She didn't have a will. There was a big custody battle, and I actually didn't get to attend her funeral because they were battling over who would have control over my brother and I. That's probably a really traumatic and far out story, but it could happen if you don't actually plan ahead and choose that.
Wow, it is traumatic. No, I appreciate you for sharing. Sorry to laugh at it, but no, that's a traumatic thing, and that's a very good reason why you should have a succession plan. It is better to meet with a lawyer and advisor on these things, but even just taking the time to think about these things yourself can really just go a long way.
Yep. And, if you don't plan and decide what you want, the state that you're in has a predetermined process, and that's how your assets are going to be transferred. And it doesn't always align with what you want.
Yeah, and no one likes dealing with the state. That's why we're here.
Yep, exactly. So the next one is a little bit more fun. Um, It's make sure for every entity that you have that you're having an annual meeting and you're recording meeting minutes.
Yeah, that's a good point, Anthony. Why don't you talk a little bit about what you can do with that meeting as far as expensing some of the items related to it?
Yeah, so just like these big corporations you see, Exxon, maybe Berkshire Hathaway, every year they have an annual meeting, and they what they do there is they review their financials, they talk about their goals of the previous year, how they attained them or what they missed, then also forward think of what their goals will be in the future. With that too, you also have the opportunity to deduct travel. These shareholder meetings at these big corporations are usually somewhere in the United States. It's not at their corporate office. So you can do the same thing. You can travel somewhere. If your family's on and in your company, you could take them along. And as long as you're spending more than 50% of the time doing business, you can deduct that travel.
Yeah, and also meals too. I've heard the common cliche one is like, let's do it in November and have make it Thanksgiving business meeting, but that's really true, you know. Um, if y'all are sitting there for a meeting, you're allowed to go cater it, and it doesn't matter how you cater it as long as it's reasonable. So having a Thanksgiving meal paid for in that way is a fun thing that we learned about on another podcast.
Yep. Make sure you keep your family on the board, but that's exactly right. As long as you're reasonable, you're documenting it. That can be deductible because you're required to have these meetings.
Yeah, Anthony, I think that's a great point. Why don't we move on to number four, which is income shifting?
Yeah. So this also is a very favorite one of mine, and this is something that you see a lot on the internet, but they don't really explain how you should do it. Income shifting is basically taking income from your business and pushing it to a close friend or family member who's at a lesser bracket than you. And the real reason on why you would do that is the tax savings. Let's say you're at a 30% bracket and you're supporting a kid in college. As long as they're performing reasonable services, you can pay them for those services. And by paying them, you're getting a deduction at your business level, and they're picking up that income at a much lesser bracket. So when you're looking at a family dynamic, the family tax rate's dropping.
Yeah, and I believe if they're under 18, you get to avoid like Suda FICA and all that, correct?
That is correct. However, there is a right way to do that. So if you're in a C Corp, an S Corp, or a partnership, you don't want to put your kids on payroll if you want to avoid the self employment tax. The right way to do it is actually by having a family management company that's wholly owned by you and put your kids on payroll through the family management company. By doing that, you can avoid the self employment tax completely. And in 2023, you can actually pay your kids up to 13,850 per year, which is the standard deduction amount, and they can be taxed at 0%.
See, this is exactly why you need a tax lawyer. That's a very great point. Let's go ahead and move on to the next one, which I believe is home office.
Yes, so this is another one that I've heard a lot of tax professionals say, oh, don't do a home office deduction because it'll cause an audit. Well, really after COVID, a lot of businesses are doing their operations out of their home. And I don't really know a business owner that doesn't work from home. So you should definitely take it because the IRS allows you to take it. You just need to make sure that you have a proper place that's exclusively used for business and you substantiate the expenses and how you use that space. But it's another easy deduction that every business owner should be taking as long as you're within the rules.
Yeah, I agree, especially since COVID. I mean, everyone I know at least works part time from home.
Yep. So I think, that's a very easy one. We should probably move on to the next one, which is the Augusta Rule.
Oh, this one's juicy. I love this rule.
Yep. So this one came around because of the Augusta tournament. Um, People were renting out their houses for this golf tournament, and Congress decided that you can rent your house up to 2 weeks without you having to report that as income. So what that has turned into now is really you can rent out your personal residence to your business for 14 days as long as you pay a reasonable rate and you document it and you have a contract. You can actually deduct that from your business and pick it up tax free.
Yeah, and I think it's great. Like, there's a lot of easy ways to document this. Like, if you rent it to your business for a business party, just go ahead and make the party as wild as possible so the cops get called. Then you have a police report to back up your, to substantiate your claims.
That's a good idea. I don't know if you have to go that far, but certainly a police report will be great documentation.
Yeah, I love that one. I think this rule is interesting too for people that like my parents, for example, are buying a house in Michigan and they're planning on living back and forth between Michigan and Texas. So they'll be able to rent out their primary residence some also. So there's a lot of cool uses you can use for this.
Yeah, and you don't have to rent it out to your business too. If like your parents, if you're traveling and you want to rent it out on Airbnb, as long as you're under those 14 days, you're not going to have to pay income tax on it. So, I mean, that's a really nice rule and congressional grace that we've got.
Yeah, why don't you talk about if so like my parents, for example, since their primary residence is going to be here, they're going to have the Michigan home that they do Airbnb out occasionally while they're not in it. But then when they are in Michigan, they might rent out their main home. So if they rent out for more than 14 days, are they still able to exclude those 14 days?
Yeah, so you can exclude up to the 14 days. Anything over that would be taxable.
Exactly, great example. So since they're already getting into the Airbnb space because of this as part of their retirement, it kind of just gives them a little free cash in the pocket.
Yep.
Alrighty, let's move on to prepay expenses from here.
Yeah, so this one actually is not just for business owners. This is for individuals as well, even if you don't have a business. And it's to prepay expenses that hit your Schedule A on your tax return. And, I know that sounds weird, but what Schedule A really holds is medical expenses, property taxes, state and local taxes, charitable deductions. So, you know, one way you can do this is pay your property taxes in January one year, and then also when it comes to you in December, pay it in December. By doing that, you get over the standard deduction amount, hopefully, and you can start itemizing your deductions.
Yeah, Anthony, let me stop you right there because you're going to freak a lot of accountants out with this one. This is pertaining to tax specifically. This is not GAAP for accountants. In accounting, prepaying expenses to try to not pay tax is obviously a normal thing. This is perfectly legal. You are allowed to do this.
Yes, definitely not talking about GAAP, but just straight tax here. But also, in the spirit, you can also prepay expenses for your business as well. So, if you're going to have a professional fee or, you know, any type of office equipment, vehicles, things like that, go ahead and purchase it this year if you've had a great year. That way you can get the deduction this year and time value of money. You can use that and save it and invest it in your business.
Yeah, and this is definitely something you do want to talk to a tax advisor or your CPA first, because some of those larger items will end up, we will end up depreciating over time instead. So some of those you won't gain the full benefit. That's why you want to talk to your CPA or a tax advisor about it.
Yep. And, for you guys out there, this year's 80% bonus depreciation. Next year, it's supposed to drop down to 60. So if you want to buy heavy vehicle over 6,000 pounds or get a cost segregation study done on your Airbnb short-term rental, this year is a better year to do it than next year because that bonus depreciation drops down to 60%.
Yeah, and all those write-offs, depreciation related, are going to keep going down for the foreseeable future unless we have another big tax plan come out soon.
Yep. Yep. It's supposed to sunset, I think, in 2025. So next year, with the election year, we're probably going to have a big year. There's going to be a lot of talk about it, but we really don't know what's going to happen.
Yeah, so let's move on. This next one, you've probably heard some stuff in the news about it. I think it's just as cool as the Augusta Rule. Well, cool for us, scary for everyone else. But that's to dissolve or form any entities needed and not needed. So, Anthony, I'll let you explain why.
Yeah. So next year is a really big year for business owners because there's a new law coming into effect called the Corporate Transparency Act. And what that is the FinCEN, which is financial crimes. They are requiring every single business owner, except for a few exceptions, mostly large businesses, to report any beneficial ownership and managers. So for every LLC that you have, any type of company, you're going to have to report this. And if you don't, there's a $500 per day fine, up to $10,000 per entity. Also, besides that, if you don't need an entity anymore, go ahead and dissolve it before a year end so you don't have to pay another year's franchise tax, tax returns, things like that.
Yeah, I think that's a good point. I think for some of the older entities, if I'm correct, it's like pre 2020 or pre 2019. Those will be the ones that are more excluded. But most entities were created in 2020 or later, especially your common LLC. And those are the people we're talking to. Those are the people that aren't prepared for it. And now's really the great time to go talk to a tax advisor about it because, yeah, I mean, it's kind of scary. It's overwhelming. If you weren't comfortable opening your own LLC, if you paid someone to do that, you want to pay someone to do this too, because it's just as complicated and overwhelming.
Yes, and we're actually offering a service at my law firm for annual compliance. We'll file this report, and we'll also do your annual meeting minutes. That service is $250 a year per entity, and we'll handle all of that for you, so you don't have to worry about it.
Anthony, that was a great talk. I think we hit a bunch of important notes. Everyone that's listening to this podcast, I'm going to let Anthony do an outro before I leave, but I want to thank everyone for listening. This is our first official recording. It was a little awkward for us. We're trying, though. We will get better. But we appreciate every single one of you.
Don't forget to follow us on social media and subscribe to the podcast for future episodes. Thank you.
Thank you.